Oil prices act as a vital signal for the global stock market. They influence production costs, inflation, and everyday consumer behavior. Petroleum is a primary input for manufacturing and global logistics. When oil prices climb, profit margins in these sectors often shrink. This squeeze frequently leads to lower stock prices for many companies. Rising gas prices act like a stealth tax on household budgets. Families divert money away from retail and dining to pay for fuel. Persistent oil spikes fuel inflation, forcing central banks to act. The Federal Reserve may keep interest rates higher for longer periods. High rates devalue the future earnings of tech and growth companies. However, energy producers often see their stock prices rise with crude. In April 2026, a major shift occurred in global market dynamics. A 2-week ceasefire was announced between the United States and Iran. This sudden truce brought immediate relief to global financial markets. Investors viewed the news as a reprieve from escalating regional threats. The Dow Jones Industrial Average surged by over 1,000 points. The S&P 500 and NASDAQ also experienced significant, widespread rallies. Crude oil futures plunged rapidly, falling below $95 per barrel. This drop reflects hopes that the Strait of Hormuz remains open. That vital waterway handles 20% of global oil flow daily. Keeping it open ensures that tankers can continue their transit safely. Despite the crash in oil, gas prices at pumps move slowly. Analysts predict that prices may ease by a few cents daily. However, a return to $3 gas remains unlikely for now. Depleted inventories continue to keep pressure on overall energy costs. High insurance premiums for shipping also prevent rapid price declines. Market remains sensitive to every geopolitical shift in headline. Investors watch the ceasefire progress with cautious, hopeful eyes. Stability in the Middle East is key to global economic health. As the 2-week window progresses, markets look for lasting peace. Lower energy costs could eventually boost consumer spending power again. Lower inflation expectations may also encourage more stable market growth. The relationship between oil and stocks is deeply interconnected. Every barrel traded reflects the current state of world affairs. Energy independence remains a long-term goal for many global nations. Until then, the market will react to every supply chain update. Traders analyze the impact of the ceasefire on future earnings. Companies reliant on shipping are breathing a sigh of relief. The manufacturing sector anticipates lower overhead costs in coming months. Tech stocks are finding support as interest rate fears subside. Consumer confidence is tied closely to the price at the pump. When gas prices fall, household sentiment usually begins to improve. This creates a positive cycle for retail and service industries. The ceasefire serves as a reminder of how fragile markets are. Geopolitical events can change the economic outlook in an instant. Investors must remain agile to navigate these rapid market changes. Diversification helps protect portfolios from sudden energy price shocks. The energy sector remains a hedge against inflationary pressures. Understanding these dynamics helps investors make more informed decisions. The April 2026 truce is a critical case study for analysts. It highlights the link between diplomacy and financial market performance. Global stability is the foundation for sustainable economic prosperity. As the ceasefire continues, the world watches the oil markets. Every cent saved at the pump helps the average family budget. Every point gained in the market boosts investor retirement accounts. The path forward depends on sustained peace in the region. Economic recovery is a delicate balance of supply and demand. Market participants hope for a cooling of global tensions. The future of the economy is tied to energy security. Peace, stability, and energy flow remain the pillars of prosperity.